Welcome, everyone. I'm Angelo Robles, and welcome to Family Office TV. I'm also the founder and CEO at membership organization SFO Continuity, and of course, Family Office Masterclass. We have a great program for you today, a subject that I think many of you in the ultra high net worth community have heard of, but don't really quite understand the incredible benefits that it provides. I'm labeling today's session the most extraordinary tax, estate, and investment structure for alternative investments. We have a very special guest. He's been a longtime friend and acquaintance. His name is Michael Liebeskind. Michael graduated from Princeton University. He was for many a year at Coopers and Lybrand. He's also very entrepreneurial. He's the founder of a couple of iconic companies in the financial services community, Sally Fund Services, Kovala Group, and where I first met Michael, probably about 17 or 18 years ago, Wing Keel. He currently is the founder and managing principal at Golconda. Michael, welcome to the show.
Thank you, Angela. I appreciate your having me.
And for my audience, I've been in this community a long time. I've known some incredible people. I'm specifically extra interested in the tax side. You could say that I'm tax sensitive. There's not many people, I could probably count them on one hand, that are very, very deep in their knowledge of understanding billionaires, taxation, and various structures and how they intertwine. And the opportunity for what we're going to talk about today, honestly, Michael is the leading thinker and thought leader. So it definitely is a pleasure to have him on. Michael, let's talk a little bit. When almost every family of great wealth is going to have assets in what I would say to some degree are non-traditional investments, we may label them as alternatives. Imagine not only here in the US do they have federal taxation, but depending on the state and depending on the city. So if they're in New York, they have federal, they have the state of New York, and they have city taxes. Their income tax bill as an ultra high net worth individual, assuming with income, which we're going to make that assumption at that level they have, it could take well over 50% of their assets. So unfortunately, certain kind of strategies and alternatives, like a lot of long short hedge fund managers, but definitely others, are wickedly tax inefficient for the super rich, ultra high income, quote unquote, earners, and not just in New York City, other states, period, because of federal, and other states that have state taxes that are expensive, Hawaii, California, Minnesota, and many, many others. So a challenge has been, how could they still invest for the diversity benefits, for the accumulation, but not be taxed as inefficiently? And if you could talk a little bit about broadly initially private placement life insurance and even private placement variable annuities, how that provides a solution to a problem.
Okay, terrific. Private placement life insurance and annuities have been granted, along with other forms of life insurance and annuities, have been granted tax preferences under the Internal Revenue Code. These are all well thought out, and they're designed to create incentives for various types of behavior that the Congress has determined achieve a social good. One of those benefits is to have people acquire life insurance for the purpose of making sure that they are providing for their families or that they have sufficient liquidity to meet the burden of estate taxes that will be coming later on. As far as annuities are concerned, it was determined that it would be beneficial to provide incentives for people to save more money, to have more money generating returns through investment vehicles in our economy and stimulate economic growth that way. And so some tax preferences were created for annuities as well. And our job as professional advisors to clients is to assess their situation and determine whether there are tax preferences that are available to them that can enable them to generate superior after-tax results for their families. And our perspective is very long-term. We're looking intergenerationally when we make that assessment.
Of course. And I think the core benefits that the majority of the audience would be familiar with on cash value accumulation life insurance is it has two significant advantages. Well, multiple, but we'll start with the two that most are going to be familiar with. The accumulations accumulate tax deferred, and the death benefit is income tax free. Now, I did emphasize income tax free, and that's a tremendous benefit. But for those with significant net worths, it is going to be subject to estate taxes, but there's going to be strategies and trust structures to mitigate or hedge against that risk. For those of you that think this is going to be a hardcore, if you're not as familiar with PPLI, its acronym, insurance discussion, it's not. Insurance is important because it provides a lot of value, but this is a deep, intellectual, effectively tax and diverse discussion that, in my experience, I'm going to say every billionaire is broadly familiar with, and probably about 25% to a third have moved forward on some form, in my opinion, and my experiences over decades, of a private placement solution in life insurance and annuities. So if you're not as familiar, listen up. It can get a little complicated, but I think there's a lot to learn. So talk a little bit about the difference in private placement from an investment option perspective versus how many may be familiar with universal life, traditional, or cash value that is more fixed and they don't have any control over.
Okay. So for the first thing, and you mentioned it before, PPLI is a life insurance policy. Now that has a potential negative connotation, but if we eliminate kind of everything we know about life insurance and how it's sold and what investment options are available, we just imagine having a capacity to create an investment vehicle that is shielded from income tax by conforming that investment vehicle, by arranging that investment account to adhere to the rules that provide these tax preferences for a life insurance policy. It gets a little bit more interesting. So you mentioned before income tax preferences that are available to life insurance policies. You mentioned the accumulation tax preference. That is that value as it's accruing inside of a life insurance policy. All forms of life insurance, including PPLI, will be deferred from current period income tax for as long as the money remains in the account. You also mentioned that ultimately when the insured person dies, all of that accumulated value that had been deferred from income tax all those years gets paid out free of income tax because life insurance proceeds paid to a beneficiary are free of income tax. There's a third tax preference that you and I have talked about quite a bit in the past, which is that if, for whatever reason, money is needed from this account for consumption or maybe to make an investment for whatever purpose, we can take about 85% of the then current value out of the account tax-free as well. And that's done through a combination of withdrawals, which up to cost basis are tax-free, or policy loans, which will carry a little bit of an extra fee, but not material. So through those three mechanisms, money that's invested through a private placement life insurance policy will be inherently tax exempt as long as it's structured properly, which it would be, and administered properly, which it would be. What differentiates private placement from all other forms of life insurance are two things. First, at least I've been doing this for 20 years, and I was actually very happy to hear you talk about how widespread knowledge around PPLI is, because it was sure different 20 years ago. But the two things that make private placement different at first is that there is full transparency, at least the way we practice, full transparency into all the fees and charges. When you have full transparency of fees and charges and very wealthy clients with sophisticated financial advisors, you're going to have commoditization of fees. That's a good thing. The fees are highly commoditized. The second thing that differentiates private placement life insurance from all other forms of life insurance is that we have a broader array of investment options. Why? Because the market in its private placement form is confined to qualified purchasers, individuals or entities that have $5 million or more of investable assets. And under the rules established by the SEC, qualified purchasers are entitled to allocate both to registered funds, what you would think of as traditional asset class funds, and also to non-registered, or what you would think of as alternative asset class funds. So we are able to combine into an investment account that is structured to conform to the tax rules of a life insurance policy. We're able to combine low cost fees and charges with the widest array possible of investment alternatives. You mentioned a moment ago that all of what we've been talking about so far is income tax preferences. We look at this, as I said before, in terms of intergenerational wealth optimization. And in order to do that effectively, we have to bring in a third professional discipline beyond investment management, beyond life insurance. And that third discipline is estate planning. And so we want to make sure that we're situating the ownership in an environment where assuming the family has the flexibility to do this, where there's no estate tax, at least for appreciation on returns over a hurdle rate. If we can do that, that's on the ownership, and then we're going to want to fund the policy potentially either from that same environment or from an environment like a personal balance sheet or a trust that's not a perpetual trust that will ultimately be subject to estate tax. You mentioned before that this can get complex. In its simplest form, it's very, very simple. It's a life insurance policy where we have a lot of flexibility on what we can invest in. In its more complex form, when we integrate the intergenerational wealth optimization, it definitely gets more complex. We work collaboratively with the client's other professional advisors, but that carrot is worth the chase because the amount of tax savings and the resulting difference in value that will remain with the family can be really tremendous over time.
It sure can. So you said a lot there. I kept it relatively simple with the growth of the internal cash value is tax deferred and the death benefit upon death. It is life insurance after all, which serves a tremendous purpose, not just from society, but from a family perspective with liquidity. And depending on the scale of the family, the life insurance and other liquid options, effectively liquidity or leverage liquidity, I might add, at death. But a incredible value that you mentioned, I think deserves a little bit of extra attention, is you could access FIFO, first in, first out. So up to your basis. I can't really think of anything else that I'm putting into effectively a vehicle structure that is liquidity and has assets or alternative investments, in this example, usually with private placement life insurance. And I can access the basis that I put in and then the growth, and we certainly hope there's growth. I could do very, very effective low-cost loans for internally. There's no approval needed. It's all internal in the policy. That is incredibly unique to life insurance in general, cash value life insurance, compared to anything I could think of. Am I wrong, Michael?
No, you're right. It's unique in that manner. There is no other tax-deferred vehicle where we have first in, first out, return of cost basis tax treatment. So that's tremendously beneficial, and the ability to take low cost policy loans. The underlying asset either way is liquidated, but the distribution is characterized above cost basis as a policy loan, so it's free of income tax. This is particularly valuable when, as is the case most of the time for the transactions we work on, the PPLI investment account policy is owned in a generation skipping tax exempt trust, because those trusts are designed to last, in some cases for 1,000 years. We want to be able to have the ability for the trustee to access policy value if one of the trust beneficiaries needs the money. And that ability to get to the money very tax efficiently and very low cost is one of the really valuable features of investing through PPLI.
Yes.
One of the thing is that a family can really think about this almost like a family bank. We've got, and most families have illiquid assets and liquid assets, and they have business interests and property. They got all sorts of complex affairs. This money that's in typically a generation skipping tax exempt environment that can accumulate value. But if the family needs it, much like a family bank, they can access the money and they can make whatever investment they want. And as the new liquidity emerges inside of that trust, they can make additional deposits or repay prior policy loans. So I like to think about this as a long-term tax shielded family bank.
That's an excellent analogy. I'm going to steal that from you and use that one in the future. So thank you very much. It's ironic you didn't plan it this way. It's almost too perfect. But I came back after several weeks in Europe, and the highlight of my trip from me learning, which is why I went on the trip, it was a business trip. And my audience is finding out about this in my write-ups and some of my released interviews and some of the solo interviews I'll be doing. But I met with multiple, we don't really have this here in the US yet, Michael, but multiple, I believe it was 2 specific families that trace their lineage of wealth going back about exactly 1,000 years plus. Now, things are different in different countries. Things are different back then. But is it possible, which is one of the things that I'm talking about coming back from this trip, are there lessons learned from such families, obviously, on governance, on structure, on legacy, on generational assets that have withstood the test of time? But is it possible in the US for a family that has arguably enough wealth already, or the leverage of life insurance being very favorable, especially depending on structure, to kind of create a dynastic amount of wealth in a specific state of structure or offshore that has no rule against perpetuities, where in theory, depending on investment returns and who knows what can happen in the future, that legacy, if your legacy is important to you, it could effectively practically assure, with a couple of moving parts, that your legacy could last for, I don't know if I'm going to quite say 1,000 years, because you just don't know what's going to happen, but a long, long, long time. It is absolutely possible. I think the main thing the audience is going to want me to focus on, Michael, since I have a lot of investors, is, okay, I've heard of private placement life insurance. I know it's on the chassis of very favorable benefits on quote unquote life insurance, but the real value to me is going to be, we have dozens and dozens, if not hundreds, of alternative investments. And some of them, not all, but some of them are not taxed overly efficiently. Henceforth, I would like to have some of them inside, quote unquote, a private placement life insurance policy. But it's a little bit more complicated than that, depending on the GP, their LP interest. If you could talk, now this may start to get a little bit in the weeds, but if you could talk a little bit about the investment process and how that's structured.
Okay, good. So in order to have these tax preferences, there's no free lunch. There is nothing that's perfect. And the give up on PPLI is that you don't get to choose the specific investments being made. So, for example, if you're an entrepreneur and there's no investment manager on earth that's going to compete with you in the deployment of capital in your area of expertise. I accept that as a given. Otherwise, the entrepreneurs wouldn't be sitting in the chair they're sitting in, and I wouldn't be serving them the way I am. So that we're not competing with capital that an entrepreneur can invest in their own business. But for the rest of the capital, there are certain asset classes where it would just be almost impossible for the decision that is made by the family to matter more than the structure around that investment. And I'm going to give you an example that resonates with the most sophisticated clients we deal with. Many, many, many clients over the past 10 years have made an ever-increasing allocations to the asset class of private credit. So as banks have withdrawn from certain markets, private investors have filled that gap. Very steady, very high return, risk-adjusted, very attractive asset class. However, the returns are fully tax inefficient. So using your example before, if you live in New York, or even Florida, but if you live in New York, which is where I am, and you're earning a 10% return on your your private credit investment, you're going to net probably somewhere around 5%. So you're losing 500 basis points to income tax. The fees for a PPLI policy played out over time are going to be a small fraction of that 500 basis points. So you would have to have otherworldly powers to be able to select a specific private credit manager that can outperform the private credit managers that already have insurance dedicated funds set up to receive allocations. There's simply not enough investment alpha in that asset class for the return that's generated through manager selection to be greater than the tax savings from housing the investment in PPLI. For that reason, we have an awful lot of funds that have been created by private credit managers to accept allocations in this market. If a client says, well, no, I don't want to allocate directly to the private credit managers, I would rather hire an investment manager, my registered investment advisor firm that handles my money. I'd rather have them create a discrete pool that I can allocate to that itself has as its investment mandate a diversified collection of private credit investments. Terrific. You can do that too. You can pretty much have whoever you want manage the money. What you cannot do, though, is if the fund exists on the insurance company's roster, great. You can dictate the allocation to this fund, how much to that fund, how much to that fund. But what you cannot do is you can't call the fund manager and say, hey, make this loan, don't make that loan. You wouldn't have that level of transparency anyway. But the specific investments of how to fulfill the investment mandate for that private credit fund has to be made by an independent third-party manager, a private credit fund manager, or an independent registered investment advisor firm. So if somebody is looking at private placement life insurance and they're thinking, well, this is not very attractive for the money I would invest in my own business because I wouldn't get the tax benefits because I would be deemed to have too much control. That's true. It's not suitable for investments of capital in your own business, in your entrepreneurial activity. That you should do away from this. Or if it's something like private equity and your ability to discern which private equity investment is going to be superior than which other private equity investment, great. That's terrific too. Do that away from these accounts. These accounts are for the portion of your investment portfolio where there's simply not enough investment alpha in the asset class to outperform the tax attributes that come with private placement life insurance, or they're asset classes where you don't have enough expertise to differentiate one versus another potential investment to determine how to optimize your investment alpha. For those investments, which for many, many clients represents anywhere from 30% to 100% of their portfolio, for the rest of that money, the money that is not under your direct entrepreneurial control, you should take a look at private placement life insurance and do the math to determine whether it's compelling enough to bear the inevitable brain damage and nuisance that having another structure in place will create.
And how about if I'm an LP in whatever, dozens of different funds, say private credit, hedge fund, and other funds? I identify that some of them, because they're tax inefficient, would have been a great fit for private placement life insurance, but the chassis that I'm using as an underlying insurance company, it's not one of the platforms that's available. Would I be able to customize something, or depending on the scale that I am as an LP, could I call the GP and see if they're willing to have an insurance dedicated fund?
So every new fund that's created, you refer to as an insurance dedicated fund that's offered for and available to receive allocations from private placement life insurance or annuity policies, every one of them was created because a single client either was going to bring new money or was going to take money away. So that's how new funds get created. We often, by the time a client turns their attention to income tax shielding through potentially the use of private placement life insurance, we often wish, and so does the client, that we had met them 5 years earlier, before they had made all of those commitments to investments that are now in place. So if a client's got dozens and dozens of existing LP interests, we cannot take those investments in. They have to redeem out of those investments, and then as the liquidity emerges, reinvest by making premium deposits into PPLI and then allocating, in some cases, to the same fund manager, and in other cases to managers that are close cousins of what they had invested in previously. And it can take time for that transition to emerge, but we're not in a hurry. The typical life expectancy for the person who's insured under a PPLI policy is going to range between 30 and 60 or 70 years. We got a long time horizon, long life expectancies.
Exactly.
So if it takes us 5 years to make the transition, it doesn't really matter. And actually, as a practical matter, in order to get these tax attributes, the three big tax attributes we mentioned before, deferral from current period income tax, ability to access the money tax-free, and the life insurance proceeds being tax-free at the end, in order to achieve that, we have to sequence the deposits in over time anyway. We can't take a lump sum. And we'll typically show clients what it looks like if they fund the policy over 4 years. That can get compressed usually to 18 months, but nonetheless, one way or another, there's going to be a pacing to it. So if it takes a while to transition the assets from the tax inefficient environment to a more tax efficient environment, in the scheme of things, it's fine.
I think I know the answer, Michael, but I'd love to hear your perspective since you're been in it for decades. And this will be a little bit telling. The billionaire hedge fund managers themselves, how active are they, perhaps as a percentage or some of your experiences in private placement or whether it's life insurance or variable annuities?
I would say that they're less active than they should be. But some of the largest accounts I've ever worked on have been hedge fund managers, in some cases very famous hedge fund managers, who are nearing the end of their active careers. It's at that point that it occurs to them that maybe they can outperform every other investment manager in every other asset class by the tax rate that would be incurred by the fund minus the PPLI fees. And when that happens, they're very, very, very wealthy, and they're very sophisticated. They're decisive. They're not afraid of structural complexity. They are wonderful, wonderful clients.
Not to push too hard on what you said about allowable investments to be safe from a regulatory perspective for both the insurance company, quote unquote, and the policy itself and its integrity. Is it possible to have certain types of private businesses? Whether that would make sense from a tax perspective is very debatable. Venture capital, and again, I know you hinted at it, but if we could just have a little bit more clarity.
Sure. So I mentioned before an asset class that's pretty obvious as a candidate to invest in through PPLI, which is private credit.
Right.
Less obvious and underutilized, but the math is strong on, is venture capital and private equity. Now you might be scratching your head and saying, why would anybody invest in venture capital and private equity through PPLI? It's already tax efficient. That's true. It's already tax efficient. And even if you live in Florida, when you have your gain that's realized, you still have to pay the 20% federal, and you still have to pay the 3.8% net investment income tax. Now, if you layer on a state income tax, you're going to end up being over 40% even on private equity and venture capital. So they are inherently tax efficient, but the expected return is very high. Nobody goes into private equity or venture capital unless they're expecting to get a 15 to 20+% return. So if you're going to get that kind of a return, even if it's tax efficient, it's still a lot of tax in dollars. And it's the tax itself that PPLI can help to mitigate. So I think we should see more of that. Now, can you allocate your PPLI assets to a private business? Well, if you are engaged, if you've allocated it to a venture capital fund or a private equity fund, of course, they're going to be investing in private businesses with their assets. Or if you engage a registered investment advisor and they're adept at making investments in private businesses, terrific. There's no prohibition to that. Where the line gets drawn, and this is not universally agreed to. We don't have a lot of information and clarity around this doctrine called the investor control doctrine. But the basic rule is that if you control the underlying asset, an example being I run the business. If I run the business, I invest in that business that I run through PPLI, I'm still the taxpayer. I'm going to have to pay the tax on that. Why? Because you are exercising too much control. And taxation, not just in PPLI, but it's a general rule of taxation, follows control. The IRS has determined, Congress and then the IRS have to determine that opening up an investment account that qualifies for the tax attributes of life insurance, meaning a PPLI investment account, and then allocating to any of the funds, registered, non-registered, traditional, alternative asset class, there are hundreds and hundreds of them that the insurance company has put on their platform, exercising control over how to make those allocations, being self-directed, that way is fine. Or hiring an independent third-party investment manager and having that independent third-party manager on a discretionary basis invest in whatever they think is suitable to fulfill the investment mandate for that fund, that's fine. But most people who are active in this market would say that it is at least in the rough. It's not in the fairway, it's at least in the rough to be allocating through a fund or directly into a business interest that the policy owner has control of or is directing the activity around.
Is there a minimal number of investments that needs to be in the private placement life insurance or private placement variable annuity contract?
So clients often get confused by this. The client could, if they want to, through PPLI or private placement annuity, allocate 100% of the premium deposit, 100% of their investment to a single fund. That's fine. At the fund level, however, each fund has to meet a diversification requirement. The statute is actually a readable statute, Section 817. Under that requirement, so I'm the policy owner, I allocate to a particular fund, fine, or as many funds as I want to, that's all fine. But let's say I allocate entirely to one fund. That's fine. At the fund level, the manager of that fund has a 12-month grace period, and after that, every quarter, the fund has to meet a math test. Under the math test, no more than 55% of the assets of the fund can be invested in any one investment. No more than 70% in any two investments, no more than 80% in any three, no more than 90% in any four. So we need each pool of capital that we're allocated to has to work their way to maintaining, to investing in and then maintaining at least 5 investments at all times.
And changing directions a little bit, you did mention it before, Michael, that unlike traditional insurance, where it may not be quite as transparent as it could be, at least back in the day, private placement is incredibly transparent. Testing my memory a little bit on private placement life insurance, it's very straightforward. You have a cost of insurance and you have, I guess, DAC, deferred acquisition cost. If you could talk briefly about the transparency of the cost involved in the insurance contract.
Okay. And every client that we work with gets a full display of all of those fees and charges, and we measure the impact of every fee and charge on the investment return, both in that year and cumulative to date. So everything that the client would be interested in understanding about those fees is accessible to them. There are 5 fees in total, 3 of which the client should think of as tolls to get the money into the account. You mentioned a tax or a fee really for deferred acquisition charge. That's a federal tax cost imposed on insurance companies that they pass through. Many states have a state premium tax. As part of our normal work in implementing these accounts, we're typically setting up an LLC entity in a favorable jurisdiction. So the state premium tax can be influenced that way, can be minimized that way. We charge a structuring fee for the work we have to do in structuring these accounts. So those 3 expenses, the DAC fee, deferred acquisition charge fee, the state premium tax, and our structuring fee, those are charged against the premium. And generally speaking, that's going to be in the neighborhood of 2% of the premium deposit. Once the money's in the account, we have two expenses. You mentioned one of them, which is the mortality charge for the amount of life insurance that has to be maintained. Clients will ask all the time, well, how much life insurance do I have to maintain? That is the answer, unfortunately, is that it depends. It's a function of the age and gender of the person we're insuring, the amount of money we're depositing, and then time. Over time, the statute provides relief, so we don't need as much life insurance as we did in the earlier years. And then the final charge is an administrative fee. In our market, for no good reason, it's referred to as an M&E fee, but it's an administration fee. When we look at all of those fees, over time, the drag on return over a normal life expectancy, and let's just say for a 50-year-old male, will be in the neighborhood of 50 basis points per annum. More in the early years when we have the heaviest amount of life insurance we have to carry, and we have the tolls to get the money in the account, and less in the later years. But the impact over a lifetime, when we look back, we say, oh, our 50-year-old had a 40-year life expectancy, 38 to 40 years. We look back, we say, how much return did we lose from the fees in the PPLI policy? It's going to be in the neighborhood of 50 basis points. So the value proposition ends up being very simple. And again, you look at something like private credit, am I better off paying 50 basis points, or am I better off paying the income tax burden on the returns?
I think a very important question. So audience, listen up, because I'm extremely big on what I would define as broadly asset protection. Now, insurance companies, relative to banks last year in 2023, broadly speaking, had a better track record. Insurance companies tend to be very conservative, and over time, it's very, 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 very safe track record. But that being said, private placement life insurance is different than traditional universal or whole life, where it's all, I guess, within the general account of the underlying insurance company. Talk about how it's different in private placement life insurance, and I would believe private placement variable annuities relative to it being separate from the insurer, if I have that correct.
No, you have that exactly correct. Traditional life insurance, which is term insurance or whole life insurance or universal life insurance, the premium deposits are invested by the insurance company in their general investment account. As you suggested, those accounts are very intensely regulated. They need to be. And the regulatory regime, which imposes a risk-based capital metric, it requires then insurance companies to maintain a very consistent, one insurance company to another, asset allocation, about 80 to 95% fixed income, 7 to 15-year duration on their fixed income investments, and highest two levels of credit quality, 95% plus. Mm-hmm. So the portfolios, one after another, the general account portfolios look the same. General account policies are the policy owner becomes a general creditor of the insurance company. And that can be perfectly fine, in some planning circumstances. Private placement life insurance and private placement annuities are in a different category that we refer to as separate account life insurance or separate account annuity. Some people call that segregated asset account life insurance or segregated asset account annuities. And what distinguishes that from general account is that in the separate account environment, the client can control the asset allocation. And the most extreme version of that, most sophisticated version of that, is private placement insurance, where we have the ability to allocate both to registered funds as well as to non-registered funds, meaning traditional asset classes and alternative asset classes. Separate account assets are walled off from credit risk with respect to the life insurance company. So the client, when they're investing millions and millions of dollars in PPLI, they don't have to be concerned that they're a creditor of the life insurance company for their investment assets, because they're not. And so that's an important distinction, and that issue does get raised quite frequently as we're working clients through the educational process.
I think that's incredibly important. Talk a little bit about here in the United States, domestically, state does matter from a variety of perspectives, and also maybe briefly a little bit about the potential for some families, even as a U.S. citizen, that may prefer an offshore policy.
So the issue of onshore versus offshore, when I first started my career, it was the opposite of what it is today. When I started doing this, it was less expensive to acquire policies offshore.
Mm-hmm.
The onshore carriers they just were not, they were pricing PPLI with a frame of reference of the traditional life insurance that they sell day in and day out. So the PPLI in that era onshore was more heavily loaded with fees, and there was less flexibility for insurance brokerage firms to drive those fees down. But now that the market is really, I would say, has materialized and has matured, we have full commoditization in the domestic PPLI market, to the point where it's less expensive to acquire PPLI onshore than it is to acquire PPLI offshore. And the vast majority of the transactions we're involved with are onshore transactions. We have a Bermuda license, so we are agnostic as to onshore versus offshore. Carriers that sell offshore life insurance, they point out that they have more investment flexibility, and that's true. If somebody wanted to make a deposit in kind, which raises an investor control doctrine question, but if somebody wanted to do that, that can be done offshore. Another advantage of offshore is, generally speaking, the asset protection is stronger offshore. Bermuda statutes, for example, are very strongly favorable to policy owners. And if the policy owner somehow owns this asset, private placement life insurance, personally, which we almost never see, if it's not already in a trust that has asset protection elements to it, then yeah, maybe offshore to pick up some incremental asset protection is useful. But generally speaking, the offshore carriers are more expensive because when an offshore carrier, which are all very small specialty carriers, when they buy the life insurance that's needed, because we have to meet the statutory requirement for life insurance, small carrier can't take that risk, so they're going to reinsure significant, almost all of that risk. Well, generally speaking, if you're a small life insurance company, what you're delivering to your reinsurers is a small number of very large risks. In any market, if you're delivering a small number of very large risks, there's a lot of volatility in the outcome. And so the cost for that is higher than it would be for the major US domestic insurance companies that, on the whole, in their relationships with their reinsurers, are delivering a large number of small policies and a few very large policies in the form of private placement life insurance. And so there's an inherent pricing advantage that the onshore carriers have. And then that gets amplified by market behavior. Because the offshore carriers know that you would only be going to them under these special circumstances, they don't feel a whole lot of price pressure by the time you're getting to them. They know you weren't there, that they weren't your first choice. Whereas the onshore carriers are fighting it out day in and day out,
Sure,
primarily on the basis of price.
And how many, approximately in the United States, how many carriers are there that at least have somewhat of a sub-focus on private placement life insurance and variable annuities?
Not enough.
That's been the case for many a year.
And we are working hard and with insurance companies to increase the number that are active in this market. It's
Might I bluntly say it's because it's probably not as profitable to them?
Exactly.
Okay.
Yeah. It involves a high level of customization, a high level of sophistication, full commoditization. You know, there are plenty of insurance companies that would just rather sell more whole life insurance to you than get involved in the PPLI market. We have about a half a dozen credible, significant participants, insurance carrier participants in the U.S. domestic market, and then there are a host of others in the offshore market. But that number, as the market continues to grow, there is a supply-demand imbalance. There is more demand now than it is appropriate for only a small number of life insurance companies to be meeting. And obviously, in the position that we're in, the more insurance companies that participate in this market, the better. And from my perspective, I would say that about every market player. I would say that about the investment managers, and I would say that about insurance brokers as well. This is a market that's got a lot of growth potential in the future. It's not a zero-sum game for anybody. And nobody should be concerned about a new competitor emerging. And nobody should feel like if somebody does a deal, oh, that's a deal they lost. There's plenty for everyone here. And the focus should be on doing the work in a good, high quality way on a consistent basis, and implementing and administering the accounts effectively when the client gives the go ahead to proceed.
In designing the policy, in my opinion, there's a degree of art and science. If I had to overly simplify it, could you have a policy that is more geared to, I'm a very active investor, a lot of taxes, I'm most concerned about cash accumulation and my access to it, not as concerned about leveraging for the maximal death benefit. Therefore, I want you to craft a policy that is going to be most applicable. I know I need the minimal amount of insurance versus someone else who may say, I got enough liquidity. I care about my legacy and generation after generation. I want to maximize my death benefit, even to the detriment of possible accumulations of cash value. I really overly simplify that. I do understand that. But if you could talk a little bit about the art of effectively policy design.
I would say that the vast majority of clients who are interested in private placement life insurance are more interested in accumulating the investment account value as rapidly as possible as they are in acquiring more life insurance. The statutes require that you acquire quite a bit of life insurance at the outset. Going back to my example before of a 50-year-old male, if a client's putting in $10 million of cumulative premium, let's say over 4 years, that's going to require about $30 million of life insurance. So that's a pretty decent amount of life insurance that you have to buy right from the outset. We continue to hold on to that $30 million of life insurance in the early policy years. And then at some point, the client decides, hey, I'm not going to put any more money in. I want to turn my attention to minimizing the life insurance. During the period of time when we're making deposits, we have to keep the life insurance in place. But once we are done with deposits, we have a couple of intervals where we can reduce the amount of life insurance. The client doesn't have to decide today, in my prior example of a 50-year-old putting $10 million in and $30 million comes along. With that, the client could keep that $30 million in force for as long as they want, or at the right interval, when we bring it to their attention that they can reduce the life insurance, they'll have that option as well. Most clients go into this expecting that they're going to reduce the life insurance as soon as they can. And then when we get to the point where they can, they think, you know what, I actually would prefer to continue making deposits. Can I do that? And the answer is yes. Sometimes they'll say, geez, I don't have the liquidity to make another deposit, but I've got some harvests on their way. What would it cost if I just keep the life insurance at that level of $30 million in my example for another year? Can you measure what's the impact? You said before it'd be 50 basis points of impact. How much of a cost does keeping the life insurance for another year or two add to that 50 basis points? And it ends up being a basis point or two. So we do a lot of that those kind of analytics after the fact. But as I said, for the most part, clients they're viewing the life insurance as a cost element. They're not convinced at the outset that they need life insurance. If they felt they needed life insurance, they would already own life insurance. So they're typically not, having a consultation with me in the context of PPLI because they need more life insurance. If they're referred to us and they need life insurance, well, we're going to show them the full spectrum of policy types and then help them determine in their circumstance which policy type is the best way to deliver the life insurance. whether they're optimizing for long-term economics or they're optimizing for guaranteed results with the least amount of hassle. That's why we have a range of products to choose from. But in PPLI, the orientation is almost always an investment orientation.
Agree. Which is why, by the way, audience, in case you're wondering, because you're probably more used to life insurance being for the ultra high net worth part of an estate planning discussion. And it absolutely is, including in what we're talking about now. But we're not going to go too deep into irrevocable trust, estate planning, how the insurance premiums are paid, making sure crummy powers and all that. I do recommend you go back to some of my past interviews, including one not too long ago, although we didn't go too much in insurance, with Todd Ankatanovich at McDermott. That was a pretty deep estate planning discussion, if I may say so. And other ones I've done with Richard Levine, Ed Rennett Withers, Tom Handler and Handler there. There's many, many others. I'm very active in this community. But if you want a deeper estate planning discussion, those would be some of my prior conversations that you would want to listen into. Oh, we're going to get a little nerdy now. Michael, you indirectly hinted at it per my question about structuring the policy and more so for cash accumulation or leveraging death benefit. If you could talk a little bit about MEC and non-MEC.
Okay. So MEC, the acronym MEC, MEC, stands for Modified Endowment Contract. In the early years of my career, there was no such thing as a MEC. But basically, I mentioned before, there are three favorable core tax attributes for PPLI: the ability to accumulate money on a tax-deferred basis, the ability to take money out of the policy tax-free, FIFO taxation on basis, and then policy loans, and then, of course, the death benefit being free of income tax, which includes all the accumulated gains that had not ever been taxed. In order to achieve that tax optimization, the policy has to be structured as a non-MEC, a non-modified endowment contract. What does that mean? That means we have to sequence the deposits in. We can't make the deposits in a lump sum. If we make the deposits in a lump sum, which is appropriate in some circumstances, we're going to lose one of the three key tax attributes, and that's the ability to take money out of the policy tax-free while the insured person is still alive. So if we, in my prior example of a $10 million cumulative deposit, and by the way, these deposits get much larger than that, but using 10 million is a nice number that can easily multiply. If a client sequences those deposits in over 4 years, 2.5 million a year for 4 years, gets the $30 million of insurance that they need to get, we've got ourselves a non-modified endowment contract, and all three tax attributes are available. If, on the other hand, the client says, look, I never need, in the lifetime of this insured person, nobody in the family or no beneficiary of the trust, no one's going to need access to this money. So is there an efficiency if we put all the money in a lump sum? Mm-hmm. The answer is yes. You're going to pick up a basis point or two of efficiency because you get the money invested in a tax-free environment sooner. But there's a big give up for that in flexibility. And that is that any money that you take out is going to be treated on a LIFO basis, last in, first out, which means the gains is taxable first. That's bad. And if the money comes out before the insured is 50, or the policy owner, that's another question. But before age 59.5, we've got an excise tax as well. I cannot remember the last time that a client of ours acquired a MEC. It's that rare. Even if the family is incredibly, incredibly wealthy. We were talking before about, the challenges you face when you have dynastic wealth of keeping the wealth intact as the number of people drawing from the trust grows and grows and grows, preserving the ability and the flexibility to take money out of the policy tax-free while uninsured is alive, even though you probably won't ever need to exercise it. There are a lot of circumstances over the next 30 to 70 years that I can imagine where you would wish that you would preserve that right. And the cost for that is a basis point or two and a little bit of delayed gratification. I'll get clients that'll be like very disappointed they can't make a lump sum deposit. Well, 10 minutes ago, you didn't even know how this worked. So, you've delayed your gratification up until now. You haven't done it up until now. This has been around for a while. So to delay your gratification while you're sequencing deposits in to have the maximum amount of flexibility for all those years that our insured is going to be alive is well worth it, as far as I'm concerned.
Of course. And audience, so you have a little bit of context, I would say we'll wrap up within about 15 minutes. I think, of course, because I did mention it, but we didn't dive into it, and it's going to get lesser attention than what we gave to the life insurance part, because in my opinion, it doesn't have the nuances and flexibility. Private placement life insurance by some has been referred to as the Swiss Army knife of the kind of financial tax and estate community, and rightfully so. But there is another related vehicle called private placement variable annuity. If you could talk about the differences comparative to life insurance and where any advantages, really, if any, may lie.
Okay. So they're both very similar conceptually. We've got an investment account, and we're going to conform the investment account to the tax requirements for either to be treated as a private placement annuity or a private placement life insurance. To qualify this account to be taxed as a private placement annuity, we only need the platform, the investment account platform, to be administered by an insurance company. So if the account platform is administered by Schwab or Pershing or TD Ameritrade, no tax benefits. But if it's administered by a life insurance company, they don't have to manage the money. But if they're administering that investment account platform, it will be a private placement annuity. What does a private placement annuity give us? Deferral from current period income tax.
Mm-hmm.
That's it. Just a deferral from current period income tax. Then the client can make the determination on when to take money out of the account, at which point the gain element is taxed first, unless the distributions are done systematically, in which case we get some cost basis coming back with each distribution. But if we take that same account administered by a life insurance company or by an insurance company, and we add the prescribed amount of life insurance to it, now it's taxed as a life insurance policy. And we get not just deferral from current period income tax, but we take money out tax-free, and ultimately we get what is it effectively? It's the same effect as a step up in cost basis. At the death of the insured, all of the value, all of it comes out tax-free. Well, that's the functional equivalent of a step up in basis, and it doesn't matter where the asset is on. That asset can be owned in a trust. PPLI is the only way to get the effect of a step up in cost basis for assets that are held in a trust. So that's very valuable, and you lose that with a private placement annuity. So why would anybody do a private placement annuity? Two reasons. One is less significant, and that is that it's lower cost. We don't have to lug around life insurance, whereas we have to do that with private placement life insurance. That's not going to be that big of a savings, but there is some savings to that. A second reason why people do a private placement annuity is because it's just simpler and easier to acquire. We can do that with just simple paperwork. Nobody has to go through an insurance physical, and there is no qualification other than the financial underwriting, making sure the client is a qualified purchaser. In our market, we have a lot of use cases for PPLI that are pretty common. But with the private placement annuity, aside from if it's a private credit manager and they want to make their investment vehicle available in a tax shielded manner, great. Offer it in a private placement annuity. The subscription process is going to look very similar as it would just going into the fund directly. And there is a great benefit to deferring the income tax and also having the investment manager's fee effectively become tax deductible, because it reduces the amount of gain that would otherwise be taxable. And that's meaningful in an environment where investment managers are getting substantial fees and those fees are not deductible. The best use case for ultra affluent families to use a private placement annuity is when they have already done extensive estate planning.
Exactly.
Or they don't even have any heirs, and all the money that's on their personal balance sheet, which is the least estate tax efficient environment, if all that money is going to end up being gifted or bequeathed to charity at their death. In that circumstance, it makes no sense to pay the income tax on the tax inefficient segments of their investment portfolio. Because if you just house those investments in a very simple income tax shielded private placement annuity, the assets compound without income tax throughout the entire lifetime of the owner, remains on the personal balance sheet of the owner. The owner has full ownership and control of that asset. And when it's left to charity, there's no estate tax because there's a dollar for dollar estate tax charitable deduction that offsets the value of that asset in the estate. So no estate tax. And then when it's delivered to the charity cashes it in. And the charity can include a private foundation. So we have quite a few clients that use a private placement annuity for the portion of their wealth that they're planning to use to endow or increase the endowment of their private foundation.
Well, your answer to that question, Michael, actually answered about 2 follow-up questions that I had relative to variable annuities and within the charitable confines that you noted. Perhaps my last question, I remember this being more trendy. Maybe it was when interest rates were very low. Maybe it's lost luster. Maybe there's negatives that you'll inform me about. Is premium financing still a thing?
Premium financing is still a thing in the traditional life insurance market. Premium financing is used more frequently than it should be. I'll say that. It's very tempting for insurance brokerage firms to be selling premium financing. Premium financing means you borrow the money from a bank to finance the payment of premiums for the life insurance. And it looks on paper like free money. And that's an illusion. There's no such thing as free money. There's just risk that's being shifted from one party to another. But if we run across an entrepreneur who's making a tremendous return on the capital they invest in their business, and they know that they need to buy life insurance because they love their family and they don't want the same conditions that produce the high return on capital, often have that business interest, almost always a business interest, and the business interest is almost always highly illiquid. So if you love your family and you don't want to leave a liquidity crisis for your family at death, so you have to buy life insurance, but you can't bear to pay the premium because the opportunity cost of that capital invested in your business would be so great. Yes, by all means, borrow the premium from a bank, use the policy as collateral. You'll have to post some additional collateral. That's still a thing. Is that anywhere near as attractive or as widespread as it was when interest rates were very low? No. That market took a huge hit when interest rates went up, and clients that didn't do it because they needed life insurance, clients that were attracted to it because it looked like free money, are paying the price now for having much higher interest rates than perhaps they thought of at the outset. So premium financing has a role in financial services when a client needs life insurance, traditional life insurance, but it just doesn't make sense for them to pay the premium themselves because the opportunity cost of their capital is too great. I do want to mention that there's an alternative form of financing premium deposits, or I would say funding premium deposits into PPLI, that's worth mentioning, and because it comes into play in many of the transactions we do. So take a typical fact pattern where the client would want to own the PPLI inside of a full generation skipping tax exempt environment. But they've either got, by the time they got rich, really rich, they were already rich, they just weren't liquid. So they didn't think of themselves as that wealthy, and they didn't do a lot of estate planning until they had a liquidity event. Or maybe they did some planning and they used GRATs to remove the asset from the generation of the principal. Well, that's great. GRATs are great, but those resulting trusts are not fully exempt from estate tax. They're exempt at the generation 1 level, but those assets are going to be subject to an estate tax at the generation 2 level. So as I said before, in many, many cases dealing with ultra affluent families, we want to own the PPLI policy. It's typically a portfolio, and we can have multiple insureds, by the way, which we often do with wealthy families. Those policies are typically owned in a generation skipping trust, but it's not unusual for the generation skipping trust not to have that much money. Maybe the client used their lifetime exemption.
Exactly.
Gifts, okay, that's for the kind of families we work with, that's not going to get you very far. A lot of those families have done grats, and there's a lot of money in trusts that were funded with grats, and there's a lot of money on personal balance sheets. So we often look to the personal balance sheet and to the what we call grat remainder trusts as potential funding sources through loans to a generation skipping trust. And those loans are made for the purpose of acquiring PPLI. Loans that are made intergenerationally for the purpose of funding a life insurance policy qualify for enhanced treatment under the regulations that were established back in 2003, and actually they go back even further than that. Those loans are called split dollar loans, and they have their own package of tax preferences. The duration could be a very long time, not limited to 20 years. It could be the entire lifetime of whoever we're insuring. We can accrue the interest the whole way. We can lock in the interest, of course, at the long-term applicable federal rate, which is high now, but will a little bit over 4, about 4.5. But that type of loan routinely gets renegotiated. And most important of all, we don't have to have any particular amount of seed capital in our generation skipping trust. In a normal loan, you have a ratio that most trust and estates attorneys adhere to, where you have to have $1 of seed capital for every $9 of loan that you're making. Those rules don't apply to split dollar loans. So we do a lot of what you might broadly refer to as premium financing. We think of it more as separating the ownership of PPLI from the funding of PPLI. And those can be two different entities.
Absolutely. And again, we could have a multi-hour discussion about the multifaceted utilization. We didn't go too much really until now into the estate planning, split dollar. It does get complex. There is definitely art and science, which makes it unique. There's 7 core areas in my conclusion, Michael, that I generally, in my 20 years in the community and having dealt with thousands of single family offices, and even in the masterclass that I created now, creating or reimagining into a top 1% family office, I talk about investing, taxation, estate leverage or planning, asset protection, philanthropy, governance, including rising gen, and effectively day-to-day concierge. Those are easily, no surprise, those are the big 7. The ones that relate to finance, the first 4, investment, taxation, estate planning, AKA or leverage, and asset protection. I don't know if I could think of something like private placement life insurance that effectively could be a pretty dominant part and touches all 4. What I'm trying to tell the audience is you're foolish. I'll just be blunt. If you're not given consideration as a family of great wealth or working in a family office about this kind of structure, get rid of your connotation about life insurance. And the positive connotation is life insurance serves an incredible purpose. That's why it gets specific benefits, governmental, AKA tax benefits. It serves an absolute, very obvious societal purpose. But get rid of that connotation from the perspective that we're talking about today. And yes, I understand it includes medical and all that. It's life insurance after all. It's a incredible vehicle that is understood, pardon the bad English, not utilized enough, even you said, by current people that are billionaire, quote unquote, hedge fund managers. I don't know if part of it is ignorance. Usually it's their advisors around them that may not feel comfortable enough with what could be a little bit complicated, although you definitely simplify it. And I think there's other reasons as well. We don't have to go into every little nuance. But I will say, I've been touching wealth management for 35 or 40 years. I'm pretty old. I've been familiar with private placement life insurance going back to my days in Coley and Bowley and Arthur J. Gallagher and companies back in the 90s. It's a very powerful vehicle. At least, like I say on investing, do the research, think for yourself, and form a conclusion. And if the conclusion is no, and you have a thesis as to why, that's fine. You put in the work, I respect that. But to just simply be flippant and ignore it is foolish. This touches such a large part of why there's a family office to begin with. Okay, I'm going to get off my high horse, which is hard for me, Michael, apparently, from what the audience always tells me. And I'm going to until I give a little bit of my wrap up information of how to reach out, kind of the closing wrap up to you and how people can learn more about you and your firm and reach out.
Well, I really appreciate your having us on. And it's just a wonderful opportunity for us to reach your audience. My name is Michael Liebeskind. You can reach me very easily by emailing me at michael.liebeskind@golconda.com, or you can feel free to give me a call as well. My number is 917-612-4525. 917-612-4525. And be certainly happy to have a consultation. I will mention that if no is the right answer, with all the experience that we have doing this work with families, and over the years, some of them have said no, we really are pretty good at recognizing when no is the right answer, and we feel obligated to bring that to the fore early in the discussion to save everybody the time and energy that would otherwise have to be invested if no is going to end up being the right answer.
And I'm going to spell Michael's last name. Please correct me if I'm wrong, Michael. Liebeskind as in boy, Eskind as in David, correct?
That's correct.
And the company name is G as in George, OLCON as in Nancy, D as in David, A as in Apple, correct?
That's correct. Yep. Thank you.
I highly recommend. I mean, Michael is he's the pinnacle in terms of what he does. He's going to be too modest, but he's kind of an iconic figure in the community. I could go back to my early days, even in the insurance industry at Gallagher and others, and I'm going back multiple decades ago, and back then, everyone knew who Michael is. So like imagine now with his deep experiences, I think it pretty much you're doing yourself a disservice if you don't reach out, get educated, form your own thesis, and make your own decision. But you do owe it to yourself as a professional or a family, whether working in a family office or advising one, that you be more familiar with something that is such a powerful and admittedly slightly complex vehicle, structure, tool, whatever you want to do, however you want to call it. If there's any confusion to reach out to Michael, you could certainly reach out to me. I'm more than happy to make an intro. There's nothing in it for me, by the way. I'm not an insurance agent. I'm not a broker dealer. I do it for value in terms of giving back to my community. Everyone, I'm Angelo Robles. And again, for folks that maybe haven't heard me in a long time, many of you would know me as being the founder and longtime CEO at Family Office Association. I sold my interest earlier in 2023, took a little time off. I am Mr. Single Family Office. It's all I know and all I love. So of course, I'm going to get back into the community that I love and that I'm very prideful for. So I created not just my media arm, which is Family Office TV, but my very intimate membership arm at SFO Continuity, and really a baby of mine, being an educator at heart, deep immersive knowledge on multiple aspects globally. Trust me, I've been to Europe many times, and upcoming Asia and the Middle East, in terms of deep educational masterclasses, which is why I created Family Office Masterclass. And coming back from my trip to Europe, meeting with multiple families that go back, like I said, 500 plus years to over 1,000, and other calls now that others have heard about that lined up from the Middle East to other parts of the world. Like I have to revamp about 20% of my masterclass because I learned so much that it caused me to be very careful about convictions. Then you get tied in to your blind spots and your ego, and you're not willing to adapt. And that's a mistake. How the world works is kind of changing, and you need to adapt with the times, and don't get so hard on my convictions are always right. No one is. And by the way, some of the verbiage I just used comes from someone who probably has more money than you, Ray Dalio. And I'm not saying Ray's perfect. I disagree with him on some things, but in terms of from the people perspective and his book Principles and what he talks about, completely agree, 100% correct. You can learn more about my programs very simply at my name, angelorobles.com. My email is angelo@angelorobles.com. I will be traveling a lot this year, including offshore. I have a lot to do. I'm very excited about it. Thank you all for listening and participating today. Michael, as always, great guest. Look forward to having you back and wish you the best as you're my first interview in 2024. Have a wonderful new year and a great 2024.
Thanks, Angelo.
Actually, Michael, for both of our benefits a little bit, in true conclusion, give me about 40 more seconds. I would like to remind people that this podcast, this interview, is strictly for entertaining and educational purposes per the best of our capabilities at the moment. You may hear this 3 months from now, a year from now, literally maybe 10 or 15 years from now, and so much could be different. Regulatory issues, tax issues, estate issues. At the end of the day, you, like multiple billionaires, including Michael Saylor, told me, you need to think for yourself. You need to make your own decisions. Everyone needs different liquidity needs, different time horizons, different investment purposes, if that's applicable. Therefore, this is for engaging, I hope, entertaining, as much as we can make a tax-centric discussion entertaining purposes. Think for yourself, make your own decisions. Thank you, everyone. Have a great day, Michael. Thank you.